Imagine a wildfire spreading rapidly across a dry forest, consuming everything in its path. The flames rage uncontrollably until a team of firefighters arrives with water hoses and barriers to stop the fire. At first, the firefighters don't put out the fire completely. They focus on slowing it down by dousing the flames and containing its spread. As they continue working, the fire weakens, eventually burning itself out. Once the fire is fully controlled, the firefighters create conditions for the forest to regrow, bringing life back to the area. This story is a metaphor for what is referred to as climactic action in the markets. Now, let's break it down. The wildfire represents a powerful market trend. Think aggressive buying or relentless selling, fueled by a frenzy of emotions, fear, greed, momentum chasers. The firefighters are the institutional players, the smart money, stepping in to absorb the pressure and stop the trend. The water and barriers represent the capital or volume orders and strategic actions used to slow the market's momentum. The containment. This reflects the consolidation phase where the trend begins to lose strength, and the regrowth represents the reversal where the market moves in the opposite direction after the trend has been extinguished. Now, in trading terms, climactic action is when the market experiences unusually high volume during an extreme price move, signaling that smart money is stepping in. It's the firefighting phase, where the trend starts to weaken because professionals find value at that price level and absorb the aggressive market activity. So, with volume spread analysis, you can detect climactic action by identifying unusually high volume followed by a sharp price move. This shows that professional traders are stepping in to absorb the activity from retail traders or even other institutions. Here's what to look for. The candle range or size is typically wide with a surge in volume that indicates heavy participation from larger players. The key? Absorption. In a downtrend, this is the absorption of supply. In an uptrend, it's the absorption of demand. Basically, the primary purpose of climactic action is to halt the current trend, whether up or down, and prepare the market for its next major move. Climactic action plays a critical role in Phase A or Phase B of the Wyckoff accumulation or distribution schematic. But here's the thing, we're not here to spend hours drawing schematics and trying to perfectly mark them out. Why? Because ranging phases can take time, a lot of time. In his book, Trading in the Shadow of the Smart Money, Gavin Holmes, mentored by VSA pioneer Tom Williams, explains that institutions must ensure their massive orders are satisfied. This explains why accumulation or distribution phases don't happen overnight. However, by identifying climactic action, we can start preparing for the next phase, a markup after accumulation and a markdown after distribution. This is where we wait for signs of strength during the markup phase or signs of weakness in a markdown phase. But we'll dive deeper into how to identify these in the coming metrics. Here's something crucial. Just because you spot climactic action doesn't mean you should jump in immediately, expecting a reversal. Many traders online discuss absorption during climactic action, but a common mistake is stepping in too early, assuming an immediate reversal will follow. While the intention to act quickly is understandable, this approach is risky because trends can often continue before the reversal happens. The thing is, absorption can appear in different forms. Just because you spot it doesn't mean it's time to take action right away. Context is everything. Without considering the broader picture, you risk getting in prematurely or misinterpreting the market's intentions. This ties back to why institutions don't always agree on value. One institution might perceive value at a certain price level and absorb aggressively, while another sees it differently, leading to conflict. This disagreement often results in what's called a bidding war, where heavy volume appears on both sides of the market. Imagine institutions battling it out, some aggressively buying while others are equally aggressive in selling. The result? A tug of war. And that brings us to the next key metric, two-way absorption.